Amnish, good morning. Can you hear me?
Hi, Nikul.
You have a very strong association with the FMCG sector. You've tracked the sector for years now before you took over this new role. What do you make of HUL numbers?
By the way, Nikul, I'm still tracking the
Are you
sector.
still tracking it? So
Yeah,
that is
yeah.
additional responsibility with head of research.
So, you see, the numbers, I would not say that there was anything big negative or positive in that. Okay. Because there are a few factors which are structural and a few factors which are cyclical. Now, as far as the cyclical factors are concerned, which today are visible in some of the segments, maybe due to food inflation, maybe due to the commodity inflation, so that will go away. Maybe you can say 3Q was the worst, 4Q might show a little bit better numbers than 3Q. But there are some structural issues which liver is facing not now, from past at least say 2-3 years or 4 years. Say your beauty and well-being. If you look at the past 6-7 years, the CAGR in growth is hardly 4-5%. You look at say your Horlicks. Okay, this MFD category itself earlier was also in a jittery. Liver has not been able to do anything. Now it's also degrowing. Now, if you have got say 50% of your portfolio where the growth rates are not there or where there are structural issues, even if the demand comes back, your growth rates will remain at best. You can say maybe a top line growth of say 5 to 7%, and you can say bottom line also more or less the same trajectory because there is very little room to increase your margins. So, in terms of numbers, we might have seen the worst. The stock at 45 times on our estimates FY27, I think it is, I would say, it gives you a fair bit of probability that there might be, you can say, some bit of appreciation. But when will that happen? And you can say, can it give you very sharp appreciation for here on, maybe say, you can say 25-30%? I don't think so. But I believe that if the demand revives, if the things look good or they improve, maybe one can expect, say, 10-12% return over the next 12 months.
That's quite interesting. Kunal, what's your reading on the chart though? Does it seem like it's a buy now, or do you think it'll continue to languish and consolidate for some time, even if one is to assume that the selling is done with?
No, so I believe that the selling should continue for HUL going forward, because we've seen the sector and the stock going through such kind of a phase where the stock goes into a 20% kind of a correction, but then post the 20% correction, and this is in a manner of a very sharp correction for the entire FMCG sector as well as for HUL. We've seen the stock going through a first phase of consolidation, but the residual correction comes back into the stock in the second half once the selling resumes, and that I believe could probably take the stock back towards, I think, 2100 mark or even 2150 levels. So my sense is that the stock could probably correct by another 5 to 10% potentially over the next 6 months. That could be a much more better buying opportunity for someone who's looking to buy or accumulate at lower levels.
Okay. Just scanning through my Bloomberg sheet right now in terms of, just give me a second, some of the big gainers and some of the big losers. And Duresh, where do you think the pain is still technically left in the mid and the small cap space?
So the pain is more in the large mid-cap names, which have really rallied over the last 2 years. And we've seen over-participation, given that the SEBI rule is 100 to 250 names is where mid-caps are considered, and anything beyond that is considered small cap, and that number itself is at 33,000 crores or more. So that basket, we have a lot of these names: EMS, you have renewables, you have a lot of even consumer companies like a lot of AC companies which did well. So a lot of stocks which did well are seeing the maximum brunt. So there could be a lot more pain as yet. And compared to that, the Nifty 50 has seen a decent enough sideways period. So the mid-cap index as such, the top 50 mid-cap names have really rallied much, much higher than the index. So there are many pockets over there, but EMS, renewables, jewelry, etc., even defense over a 2-period, railways over a 2-year period has done really well. So that is where the pain could be, either in terms of further price correction or a longish period of sideways consolidation.
Okay. Amnish, where do you think the market in the mid and the small cap space, the selling has become excess? I think I can't hear him, or his audio's gone.
I think he's mute, maybe.
Amnish bhai, you are on mute. You'll have to unmute yourself.
No, I'm not on.
Yeah, now
Now
we
I
can
can
hear
hear
you.
you.
Go ahead.
Okay. Okay. You see, what had happened over the last couple of years in particular, that the valuations in many of these mid caps and I would say small caps, they actually were exceeding the large caps. And the logic always was given that these companies are growing faster, so it is justifiable to pay high multiples to them. Now, this actually resulted in a lot of, I would say, froth in many of these, you can say, sectors or the segments where the companies are obviously smaller, they can grow faster. But what happens is that whenever there's a little bit of pressure, it comes on the economy, then those are the companies which are likely to, you can say, get impacted also earlier than many of the large caps. So I believe that I will not paint all the mid caps or the small caps with the same brush. But having said that, I think where the fundamentals are not supportive, there the mid caps still might have a lot of scope of correction. Because in this market, a lot of small caps or mid cap without any fundamentals, just on story, just on hearsay or rumors, they were rising. And that is, I think that is one pocket which might face, you can say, still the problem, not maybe say for a month or two, maybe say for several months down the line.
Right, quite interesting. Amnish, other than that, wanted to understand what do you think is behind this move in IT that we saw yesterday, or do you think it's just one of those safe havens aligning with the way the US stocks are moving kind of strategy?
I think as far as your fundamentals or numbers or visibility is concerned, I think there is no big change in stance as far as IT services is concerned. Now, you can say they are actually dancing to the tunes of what happens, you can say in US today, because that from the last say 10, 15 days, that has become the most important narrative. So my sense is that can the large Indian IT companies, can they grow in, you can say CC growth 5%, 7%? The answer is no, because they are quite a bit of size as of now. But are we approaching towards the worst? I think US might show some green shoots a quarter or so down the line, but Europe is something where I think the problem could be slightly more prolonged because they are a lot dependent on US. The European economy is in a bigger, I would say, sort of a mess. So I think the IT stocks in the near term will move more towards what happens in US, how the currencies behave and other things. And obviously, I think when the entire market is down, then people sometimes they are always looking at your IT services, FMCG, pharma as the hiding places. But I think if the domestic economic growth revives, if we see a good budget pointing more towards, you can say, renewed capex push or some other reforms, then I think IT maybe you can say just moving in line with the market and not a big outperformer.
Little, drawn or rather divided in how to read into Polycab's numbers. I mean, of course, the stock hasn't fallen up until the earnings came out. But they are talking about, a slowdown in their wires and cables business, which is the mainstay business. Now, for a stock like Polycab, which hasn't fallen at all, other than this earnings reaction that one has seen, such high concentrated, H&I positioning over there. In fact, for the entire sector, what is it that you're making about how this slowdown could actually, have a cascading impact on the way the stock could fall?
You see, if you look at Polycab and particularly the wire and cable business, I think a couple of companies more they have declared already the numbers. There are two parts to it. One is your wire segment and one is your cable segment. And if you look at the entire rally in all your power cable stocks, it was led by the cable segment and not necessarily the wire segment. Because if you look at last 3 years, there was no big acceleration in the wire segment because that is directly related to how the consumer demand pans out, how the housing demand pans out. So there is no big acceleration over there. So what was driver here was, you can say, capex. What was driving here was demand for power cable and some of the emerging segments. So I think there should be no big problem over that once the overall, you can say, capex intensity in the economy goes up. As far as your wire segment is concerned, I think that there are some, you can say, cyclical issues, maybe due to your raw material prices, destocking and that. So I think wire segment could come under pressure. Cables, I think even if there is some bit of pressure, so it might not last for a very, very long time. So Polycab, I would say it has got certain advantages. It operates across segment ranging from, say, your mid to extra high voltage, etc. So I think Polycab seems to be among the better companies in terms of scale, in terms of margins and profitability. Yes, the stock has, if you look at last 3-4 years, from a P multiple of 15-17, it has rallied to more than 35-40. So the incremental returns will be more measured. But having said that, I am not negative on the cable side of the business.
Quite interesting, your take, Amnish. But good to have you on the show. We'll let you go on that note. Thanks for taking time out.
If you like this video, then like, share and subscribe to ET Now.